If you're a finance student or learning financial modeling or an analyst who has spent hours trying to balance the balance sheet and do not understand where to start with, then this video is for you. In this video, we are not going to randomly just inspect formulas or plug cash or try to forcefully balance the balance sheet. No. What I'm going to do is I'm going to show you a professional way by which we can balance our balance sheets in the financial models. We will isolate the problem, reconcile all the movements, and fix the model the way I usually guide an analyst in my own team. I have provided two versions of the model. One is a balanced balance sheet and another one is unbalanced balance sheet. What I want you to do is watch the video and then download both the files and try to balance the balance sheet in the unbalanced file and then match it with the balanced file. So the objective here is not to merely just locate the errors. It is basically to understand what caused the balance sheet to unbalance. And if you go with this way, it will help you in your future financial models wherever you encounter a situation when balance sheet is not balancing. And if you have practiced this 2-3 times, you are less likely to face that kind of issue in future. Now, before I dig deeper, let us quickly understand that most of the balance sheet errors will eventually fall into one of the four categories. And first category is the missing movement. In missing movement category, a balance sheet is not capturing one of its drivers. It could either be that the debt repayment is missing from the debt schedule, or probably you have missed out the depreciation from the PPE schedule, or any receivable movements, etc., are being missed out from the overall model. The second category is the double counting, wherein you are double counting dividends in the retained earnings schedule, or probably you have double counted depreciation in your PPE schedule, and something is double counted that is being rolled forward into future years. The third category is the wrong sign or wrong line or probably wrong period as well. This can happen when assume that inventories have increased and instead of showing it as an outflow, you have shown it as an inflow. That could be one of those examples. Another example could be that when there is debt repayment, you have shown it as debt increasing instead of debt balance declining. Now, the category 4 would be the totaling or formula range error, wherein like either you could have excluded total assets from one of the rows or probably balance sheet check is referencing the wrong total as well, etc., etc. Now, let's dig deeper into how to match the balance sheet. So if you see in this sheet, we have two sheets. One is the constant difference and the other one is the unpredictable or incremental or decremental differences. Now, a balance sheet error can be either of those two. So instead of you digging into straight away into all of your formulas and schedules, that's not recommended. The first thing that you need to do is to identify the pattern. Whether the pattern is a constant difference, like for example, if you see this sheet, in this sheet, these are all monthly balance sheet figures, and you will see that the difference is a constant amount. So this kind of difference can also happen. And if you see this case, wherein you'll see that the differences are unpredictable and keeps on increasing or decreasing, so that can also happen. Now, if the difference is constant, so that basically means that you have either omitted something from historicals, or probably an historical asset is not included, or probably some opening balance is missing, which is not going forward. And if you look at the pattern B, wherein the difference could be either changing or compounding, in those cases, the underlying issue is that one of your schedules is being incorrectly calculated, which is rolling forward into your future years. Example could be like incorrect debt movement. Now, that could give you a roll forward error, and probably even incorrect retained earnings movement, that can also give you roll forward error. Any of your schedules that you create, all of those can give you roll forward errors. And in most of my experience, what I've seen is that it's usually the second pattern, that the difference keeps on changing or it's unpredictable. So let's try to first address that, and then we will come to the constant error difference. So the first thing that you do in order to resolve an unpredictable difference is that you find out the most recent year which is balanced and the next year which is unbalanced. So if you see the latest year that's balanced, this is FY25, and the first year that is not balanced is Jan 26 onwards. And this is a 4-year monthly balance sheet projections. So the first thing that I have to do is to find out the difference between these two columns. This can be just this year, which is unbalanced year, which is Jan 26, minus the previous year, which is the balanced. And then I just hit enter, and I will just try to drag across all of the line items. And once you have dragged it across all the line items, I would recommend you to ignore the totals and ignore the cash. So now these are my differences. Remember, find out the difference between the year that is not balanced minus the year that is the balanced. Okay. And ignore the totals, ignore the cash for now. Now, once you have the difference column in place, all you have to do is follow this method. For each and every difference that is appearing in the balance sheet, look at the individual driver movement in the cash flow statement if it matches up with the differential amount. If it does, you mark it as green, as in it is correct, and you move on to the next. If it isn't, then you have to do further investigation, and if there is any error, rectify that error and then move on to the next. So let's see. So here, this is the first line item, which is PPE. So in PPE, if you see, the difference is 2. Let me just, it is 2.4. Now I will have to go to the cash flow statement. In the cash flow statement, what are the driver movements that impact this PPE movement? That is going to be depreciation PPE and the additions of PPE. Now, but the difference is coming 4. That means that there is some issue in this. So we will inspect further. What we'll do is that we will look at that from where these values are coming. So we will go to the schedule. So this is coming from the schedule, and additions have been linked up there. So that is correct. Now, if we see depreciation, we can see here 2.4. But let me see what is linked in the cash flow statement. So cash flow statement is linked with the incorrect line item. So this has to be this line item, which is the total depreciation expense. This is 2.4. Or you can directly link it with the schedule. So let's link it with the schedule, which is T275. Okay. And I will just copy and drag this for formula across. Now what I have to do is I will just again check now if it is coming correct or not. So this is 2.4. So this number is reconciled now. So what we'll do is we'll go to our difference. We'll go here. This is 2.4 and we will mark it as green. And we will move on to the next one. So that is what we are going to do for each and every line item. Now for ROU, we will come to it at the end. ROU assets and ROU liability, we will look at it together. Trade receivables. This is 77. This is, if you see here, 194 minus 271. Receivables have increased, so it has to be shown as an outflow. Okay. Now we will look at the corresponding entry in the cash flow statement. Receivables, if you see, it is being shown as an inflow. This is incorrect. So we just have to change this negative sign here. Okay. Now it is shown as outflow. That is fine. We will go to the next line item, which is, so this we will highlight it as this. And next line item is other current assets. If we look at other current assets have reduced. So it should be shown as an inflow. Now, if we look at the corresponding cash flow entry, this is the other current assets. It is mixed with other current liabilities as well, but we will just check how much is this being shown to us. So this is coming as 114, but minus is there outside. So it is being shown as an outflow. And if you look at this also, this liabilities have gone down. Okay. So this should have been shown as an outflow. But instead, if you look this is being coming as minus 20. So this becomes positive. It is being shown as an inflow. So this negative is a problem basically. So I will remove that. Now, this should be shown as 114. And if we look at here, This is shown as inflow. So this is fine now. We will again highlight this. And we will also highlight the other current liabilities which we rectified. Now the next one is inventories. Inventories, if you see, this is inventories have reduced. So again, it should be shown as an inflow. If we look at the corresponding here entries, so corresponding entry is correct. Okay, it is being shown as an inflow. So now we move on further. So our asset side except ROU is done, and this seems to be correct. Now we move on to retained earnings. Here there are 3 zeros. We ignore all of them and we look at this retained earnings. Now this is just 32. So we look at 32. This is here. That's all. But we have to account for dividends. But dividends, we are not paying anything in this month. So it is fine. But if you see, there are dividends at the end of the year. And if I look at my balance sheet formula, it is not considering dividends. It is only considering this. So ideally, dividends paid should also have been considered here. Otherwise, at the end of the year, it will become unbalanced. So what I would rather do is that I would rather link it with the schedule that we have created it here. So if we go down here, this is the retained earnings schedule that we have created. So we just have to link it with this line item, row number 244. And if we go to the balance sheet here, and that's all. Okay, I'm just going to unfreeze this. And then the difference still matches. It was matching before as well, but we just rectified that it should be linked with the schedules. Now, if we see provision for EOSB, if we see this is basically 5 is the difference. And we see here 5 is also coming here. So this is fine. Now, if we look at the next one, which would be leverage. Now, debt again, borrowings will be classified as non-current and current. Wherever you are looking at borrowings, if there are 2 bifurcations, mostly you will find 2 bifurcations in proper financial models. So in that case, you have to look at both of them together. You can't look at one of them in isolation. So let's look at this together. So what does this say? That this and this total bank borrowings stood at 525. Now we have to, and if we see here, debt is newly coming in. Okay. It's a fresh debt that is being raised. So if we look at our cash flow statement, we only are finding 500. We don't have anywhere 25 additional. So that means we need further investigation because it is not matching up. If we look at the formulas, usually what is happening is this is being linked here from the ending balance. It is correct. The only thing that you need to remember is that whenever you're providing bifurcation between current and non-current part of any liabilities, so for that matter, what you have to do is you forecast your current liabilities, okay, after you have forecasted your schedule. And then from the ending balance, you have to just subtract the current part. That's all you have to do. So basically, your non-current will always be equal to ending balance minus the current balance. Okay. So now I have to just make that change because other than that, my balance sheet looks perfect. It's this bifurcation or the classification that is not correct. So that is what I'll do now. So now if you see, if I add both of these up, so at that given point in time, the debt outstanding should have been 500, which is verified now from the schedule that we just saw. Okay. Now we'll mark these as correct and we will move on to the next ones. So the next one is lease liability IFRS 16, which you have to look at it in conjunction. So if you see here, accounts payables, if I see have come down, that means it has to be shown as an outflow. Okay. And if we go to the relevant cash flow statement entry, we will see here as, yeah. So we have both of these together, accounts payables and accrued liabilities. So let's just see. Accounts payable we know should be shown as outflow. So minus and minus is getting plus. And same goes, I think, here also, probably. If we see this is minus and minus getting plus. and this has also reduced. So both are outflow but are being treated as inflow. So all we do is just remove that minus. Now this part should also be correct. So we mark these as green. So now if you see, despite of our we not fully checking all of the line items, our balance sheet has still balanced. So if you see here, it is balanced. But let me, just for the sake of it, let me tell you how we would have treated IFRS 16 if we were looking at the balance sheet and the cash flow. So like I said, we will be having current portion of the lease liability part. Now, there are certain norms when you are looking at the current portion of lease liabilities. You have to only account for the amount that has been incurred. I have written a note in detail. You can look at this. But the gist is this only, that you cannot recognize the liability that has not yet incurred. So that's what we are doing here. That's what essentially this formula is doing. So once we have this in place, all you have to do is that the non-current part has to subtract the current portion. And if you look, we have linked with the schedule. Yes. So it will always be this. It will always be your ending balance of the schedule minus the current part. And same thing we have done in IFRS 16 also. But in the cash flow statement, how we would have treated is this, that when you start with your cash flow statement, in the net income, you would have to add back the finance cost. The finance cost is, if you look at the P&L, in P&L, IFRS 16 will have two impacts. First one is the depreciation of ROU, right of use assets. And the second one would be interest cost on lease liabilities amortization, which sometimes we also say as finance cost, IFRS 16. These are the two impacts that are there in the P&L. Now, when you are moving on to the cash flow statement, you start with net income. You will add back the depreciation related to the right of use assets, and you will also add back the finance cost. Now, why we are doing this is because in the cash flow from financing, you will be making a lease payment, and the lease payment is inclusive of both the principal and the interest amount. So ideally, think of it this way. If this would have been a normal bank loan, what you would have done, you would have started with net income, you would have added back the interest cost, and then you would have resubtracted the interest cost in the cash flow from financing. Why? Because you want to get the true picture of cash flow from operations. If the core business operation of the company is not lending and borrowing, then in that case, always and always add back the interest expense in your cash flow from operations section to arrive at the accurate cash flow from operations, and then reduce the same amount in the cash flow from financing activity. It's just a proper classification thing. Okay. So that is why we are adding back here the finance cost, and then in the cash flow from financing activity, we are not reducing it because it is already being reduced as part of the lease payment. Okay. So that was the entries for IFRS 16. So now once this year is balanced, all you have to do is carry forward the formulas to the next periods. Now I have made some changes in the balance sheet also. Let me first incorporate those changes here. And I will just copy them across. Now retained earnings is copied, and what I'm going to do is do the same for debt also. I have to copy this across for all the years so that it reflects correct. Okay. Now the balance sheet part I've copied. All I have to do is incorporate the cash flow related formula changes that I have made. So I'm going to copy this and paste it here. And I'm going to replace S with column T. And now once I have copied this, I have to just drag these formulas across. And that's all. Now we will copy the same thing across so that each and everything gets balanced. So most of your balance sheet got balanced, but it seems that there is still some error in this. We will figure out what it is. So let's look at this. 25 going to 45, and then again 45 going. So if you see, this is more like a step up, right? And another thing, we looked at almost all of the line items except for a couple of them. So the error could only be in those items which we didn't look, right? So dividends we covered. So we can just check what this difference is. And if you see here, I think I got this because the difference is coming from shareholders' current account. So now I know that this is because shareholders' current account is not correctly linked in the balance sheet, because this is currently linked with just the previous month. Whereas if you see in the cash flow statement, there is some outflow happening. And now all we have to just look at it, we have to just link it with the relevant schedule. So I will just go down and try to find the relevant schedule for this, which is here, row number 253. So I'll just do this, that I'll just go here and link it with row 253 and it should be fine. And I'm just going to copy in all of these rows just to be sure. So I'm just going to extend this to all of the cells so that we don't get any future error. And yeah, so now if you see, now everything is balanced. So this is the professional way by which you need to figure out the differences between the balanced year and the non-balanced year, and then find the differences for each and every differences. Look at the relevant cash flow entries, and if that makes sense, and if it is correct, highlight it, move on. If it doesn't, investigate and then correct it, and then move on to the next differential. So now this part is done. We will focus on the constant difference part. So like I said, constant difference part meaning something has been omitted. And if you are getting this kind of difference, you should be happy in that case, because that means that there aren't much logical errors in the model. Okay, this simply ideally means that one or two things have been missed. So the process that you'll follow here is again the same. You will go back, find out the differential, and then for each differential, compare it with the relevant line items in the cash flow statement and link it. The process is same. The only difference is that when you have a constant difference, you would be able to figure out the difference or the issue very quickly. But if it's an incremental difference or an unpredictable difference, then it might take you some time to reconcile and finalize the balance sheet. So here also we'll try to follow the same process, but just to make things easier, we will just copy these differential that we had created here and we'll paste it there so that we can quickly rectify. So I'm going to just paste it here. So I recognize this difference, 2.4. This is fine. This we had reconciled. Okay. I recognize this also. Out of all of these, what I don't recognize is this minus 53.9. This, if you remember, was 5, right? So you can check it here. This was 5. But ideally, we would have started from the top and then we would have arrived at this. We would have looked at this and we would have figured out that, okay, the difference should be, relevant difference should be in the cash flow, 48 or 49. But when you would have looked at here, it's only 5. So then you will dig deeper as to why is this. You will see from where is this coming, T260. Now this is the schedule for the EOSB. EOSB stands for end of service benefits. The issue is that the opening balance is being missed here. The moment you do this, your balance sheets will tie up. So if you see, everything has been tied up here. So that's all about in this video. I know it can get a little bit technical and it might take some time for you to reconcile. The first time I followed this approach was back in 2015. And it also took me 1 hour or 1.5 hours, if I remember. But let me tell you this, I did this same method at least 5 or 6 times on 2 or 3 different models. And in the matter of 1 month or 1.5 months, I was an expert at balancing the balance sheets. And since then, I have never faced issues. So that's what my recommendation is to you all. If you have any financial models lying around, just try to practice it on those and also practice on this Excel file 2-3 times. And I think in no time you will be a pro. That's all for now. If you have any questions, please feel free to drop them in the comment section. I will see you in the next video. Thank you.